Welcome everyone. I'm Robert Green, CPA and CEO of GreenTraderTax, Green Trader Funds, and Green NFH. Welcome to this week's webinar on June 21st, 2012 on the best entities for traders and investment management businesses. So on the one hand, if you are trading your own money, retail, you want an entity for tax breaks more than for liability protection. If you're managing money for others, what we refer to as investment management, you absolutely need liability protection in your management company and the right setup for your hedge fund if you have that too. And there's lots of important tax strategies to follow. So investment managers must have an entity with liability protection. Business traders, retail traders can be sole proprietors, and they may be for the past. But going forward, I'm going to point out today that there are added tax breaks and safety with the IRS, doing away with a red flag and more flexibility in using an entity. So the entity is optional for a business trader trading their own funds, and it's mandatory for an investment manager. And you can have a business entity set up that morphs into your management company down the road. I'm Robert Green. Here's my photo. And Brent Gillette will join us later from the Investment Law Group. This is educational information. We're not giving you tax advice in this session. We have a sponsor for today's session. I want to thank Rob Booker, the host of the Traders Podcast, available on iTunes. Rob interviewed me on Monday, and it's going to broadcast next Monday or Wednesday and then be on iTunes. That's a great show, the Traders Podcast. He does a great job, Rob. And I think it was a really good interview. We really got down into the details of tax audits and how they affect traders. So thank you, Rob. Here's my bio, CPA, CEO of GreenTraderTax and Green Trader Funds, Green NFH, the virtual tax and accounting firm, Traders Advocacy, the advocacy group where we fight for traders. I'm the leading authority on trader tax. You can read my books and guides and column in Active Trader, Forbes blog, newsletters. You'll see me in all the major media, especially lately on the cost basis reporting, and the main speaker and presenter at Money Show and Traders Expo. Those videos came out good down in Dallas a couple of weeks ago. Some of this session, by the way, I took from my Dallas paid class, the 4-hour session that covered everything, including entities. But I added a lot of new content to this PowerPoint. Brent Gillette will join us later. He's the senior managing partner of Investment Law Group, the founder. That's the firm for investment management. Brent's got great experience in the area, great education. He's been working with me a long time. Clients really like him. He's got really good professionals in his firm. They really know their stuff, and they do a great job, dovetailing nicely with us. So my session today, here's the overview. This was in the registration materials and also the blog. When you're trading your own funds, it can be a business. You can qualify for trader tax status, business treatment, and it's much safer to claim those benefits in a separate entity, even if it's unincorporated like a general partnership. It's just going to look a lot better if you file a Schedule C without an entity. A sole proprietor files a Schedule C. And let me get some pointing materials here. One second. So it's a red flag when you're a sole proprietor. And a lot of our clients have filed that way over the years, and they've been fine because we've included great footnotes. If they've had gains, we've zeroed out the Schedule C, so it didn't show a loss. And we made the best of the situation. But, you know, the IRS has gotten emboldened again. They hear the cry of the budget deficit, and they've launched new exam or audit programs, really ratcheting up the bar. And traders stick out like a sore thumb. So there are going to be more trader tax status related exams, and we feel that you can duck all of that threat by using an entity. So this is the appropriate juncture at an opportune time for us to really push entities where we have not pushed them before. We are advocating them now for your benefit. No one wants to have an exam. No one wants IRS threats of taxes and lots of time and effort and aggravation. So the entity helps, but the entity also unlocks additional tax breaks. We use the entity to create some earned income. Now, a business trader starts with the glass empty on earned income. Trading gains are not earned income. Conversely, the investment manager starts with the glass filled. Advisory fees are earned income. And later on, we'll talk about what's different. Investment managers use S-corps to reduce earned income. They use carried interest to reduce earned income, so they get a half a glass or a quarter of a glass. Traders start with it empty on self-employment tax and payroll tax. None of that FICA and Medicare. That's a huge savings. But they want some earned income because you need some to drive a AGI deduction for retirement plans and health insurance. Investment managers have too much earned income. Traders have none. So they both want to do something about improving their situation. Investment managers want to lop off some earned income. Traders want to put some on. And this is how they do it. What's wonderful for a business trader is it starts at zero and they have total control of what to make it. So it's not $1 too much because they want to look at maximizing income tax savings versus self-employment tax costs. So again, you get the entity to be safe for the IRS, but then you unlock these additional tax breaks. Now, today I'm going to explain the best types of entities for traders. Now, it depends on your filing status. If you're married, it might be a general partnership. If you're single, it might be a single member LLC S-corp. Depends on your state of residence, where sometimes LLCs and S-corps are nominal dollars extra, but in some states it could be a lot more, like California. And then it depends on the tax saving strategies that we're deploying. Now, this type of customization we do for both the business trader and the investment manager. And you'll see today there are lots of different moving factors, and we take them all into account. Now, I think now is a great time to form a new entity right here in the middle of the year, because the entity gets to start life anew on all tax elections. If it's a single member LLC disregarded entity, that's not the case. But if it's a separate entity filing like a partnership or an S-corp, it has all free new elections. That's great because individuals and existing entities have missed. It's too late for the Section 475 MTM election, which was due by April 15th for an individual and partnership. So if you missed it or you didn't want it, you can form an entity now for a do-over. This do-over with a mark-to-market is something we talk about a lot. You had a large capital loss carryover from 2011 into 2012. In Q1 and up until now, you didn't have mark-to-market, which was good because you had gains to soak up that capital loss carryover. And now that you have a clean slate, you want to elect mark-to-market in the entity going forward. Remember, the entity's going to pass through to your individual return. So it's going to consolidate on your individual return. Now, that example I gave you, there are 10 different versions of that example or more. And they all involve wanting to have a do-over with elections, and this is the perfect time to do it. So if you're not sure about what you're doing with mark-to-market, capital gains, and loss carryovers, check with me to go over the strategy and to see how forming an entity now, a new taxpayer, can take advantage of that new taxpayer exception to start over on elections. This is not to be understated. It's a big point. Now, while investors usually don't need an entity, it does come in handy in some cases if you want to have a family limited partnership involving the children, if you want to avoid the problematic Form 8949 for cost basis reporting. But those AGI deduction strategies for retirement plans and health insurance premiums don't work efficiently tax-wise when you have investor tax status, because the fee payments are investment expenses which are limited, and the fee income is gross income, so it's not a wash in gross income. For a business trader, that's how it works. It is a wash in gross income, so it doesn't change your income, but it unlocks these huge deductions. Now, when it comes to entities, one size does not fit all. If you go to one of our competitors, everyone who walks through the door, they say C-corp and LLC, whether you have trader tax status or not. And they talk about the C-corp in Wyoming or in Nevada. None of the asset protection works. The strategy fails business deduction treatment because you need to qualify. It cannot overcome the need to qualify for trader tax status. They often fail in your home state because you don't register them there. It's just complete snake oil. It's unethical. They're not CPAs. They just want thousands of dollars from you. It's a bad move. Get a second opinion with me. Brent Gillette will be discussing investment management businesses, as will I, how they need liability and asset protection, how you make a choice for your management company as an LLC or as an S-corp. Management fees, incentive fees are earned income. They trigger the SE tax, but the profit allocation to carried interest does not. And then we'll talk about how you can use an S-corp to actually reduce the self-employment tax. I'm not going to get into this too much now. We'll wait for Brent Gillette. He'll talk about how Delaware is the place you want to have your hedge fund and your management company, how it's just safer. The courts understand the hedge funds better. And he'll touch on the offshore entities as well. Now, just to take the temperature of everybody as we get into both of these areas for traders and investment managers, let's see what you're mostly interested in. And let me just launch a few poll questions here. The first one is, are you interested in trading entities or investment management? Let me expand this so I can read it better. So please get your answers in here. So I want to know if you're mostly here today to learn about an entity as a business trader for your own account, for trading your own money, or if you're interested in investment management, trading other people's money, whether you're already in investment management or not. So it's about what I figured. Let me close this poll now and share the results. So 85% of you are more interested in the business entities and 15% investment management, but that's pretty par for the course. And, you know, we have thousands of clients for traders and we have dozens for investment management. It's just one is trading big bucks, real serious business, and the rest is trading your own money. So let's look at the next poll question here. And then we'll get back to the presentation. Do you trade in a separate entity now? So let's get your answers here now. And there are different choices where you can say how you trade. I'm having trouble seeing the whole thing here. One second. So get your answers in. All right. And let me share the results. So 18% yes as a business trader. You have an entity now. That's good. Well, you're going to learn today how to use it to the maximum benefit possible. That's really good. Now, 8% of you have an entity, but you're an investor. And as I pointed out, it can still be useful. And maybe you're on the fence, and you might qualify for trader tax status in the near future, or maybe you may morph into investment management. And 75% say no, but a good number of you may see the benefits of having a business trader entity. You may see that you qualify. You may see why it's a good idea to do it and move forward with it. So that's great. Let's get back to the presentation now. And let me bring up my drawing tools again. So if you're trading your own funds, the first step is to see if you qualify as a business trader. Because if you don't, going down the entity route could be costly and not yield all the benefits you are hoping for. It's not a panacea for business expense treatment. You need to have the trader tax status, and check our golden rules in our Trader Tax Center on our website. They're all laid out for you there, and maybe consult with me about it. We've covered that in other sessions, so we don't have time for that today. Now, before we delve into the best entities for traders, let's review this trader tax status just a little bit to see why it's so worthwhile. Now, keep in mind, if you trade other people's money, that is a business status too. So if you come to me and say, Bob, I mostly focus on options. I just don't have enough frequency of trades, but I'm very successful and I'm going to be trading for some other people too. I really need trader tax status. Should I trade more? I say no. Maybe don't try to get trader tax status. Maybe you don't need mark-to-market accounting as much, and focus more on achieving money management business tax status, where you can deduct your expenses too. Not your interest as business interest, but you can deduct all your other trader business expenses. Now, trader tax benefits apply to any type of trader: securities, futures, options, ETFs, Forex traders, whatever you're trading. Once you learn how to qualify, check our golden rules. Maybe get Green's 2012 Trader Tax Guide. Understand that you can claim it after the fact for 2011, for 2012 year to date, for the prior 3 open years. That's all well and good for the past, where you'll use a Schedule C. But for going forward, it's a lot better to form a new entity for the rest of 2012 and subsequent years. Why do I say that? Because there are problems with Schedule C, and we started off today talking about them. When you add a Schedule C to your tax return, you're just putting your business expenses there, but trading gains go on other forms and losses. Schedule D, Form 6781, Form 4797, line 21. Depending on what you trade, it goes on all these different forms all over your tax return. And you have these Schedule C expenses sitting there by themselves, and the IRS computers and agents don't understand what kind of business that is. So we do have a solution. It looks like a losing business, and we show you how to transfer some trading gains to Schedule C to fix it. You have to do that very carefully in accordance with our content laid out in our examples guides. You can get the gold package. If you botch how you do that with a local accountant, you could cause an exam. So this has to be done right. But why deal with all this going forward? The entity tax return looks so much better than the Schedule C. The reporting is consolidated on one return, the entity return, which looks more like a business than a sole proprietor trading. All those trading gains and loss forms, those are all part of the partnership tax return, as are the business expenses. And if you have 475 mark-to-market accounting, it all nets out as ordinary gain or loss. And it just looks like a trading business. It doesn't get confused as part of your individual return where you may have wages or pensions or things like that. So ask yourself, do retail business traders absolutely need a separate entity? Technically, no. As I pointed out, they can file a Schedule C, and they've done that in the past. But the entity is much better. It's just going to look a lot better, get rid of the red flag, and unlock the AGI deductions. And it's going to unlock the flexible elections like mark-to-market. If you don't have trader tax status, you don't need the entity, although one can help in the limited cases that we discussed. Startup issues are very tricky for traders. And if you form a business entity and have trader tax status, you can catch up and get a good outcome for your startup issues and challenges. For example, it's very tricky to handle pre-business education. You go to one of the academies or schools. We work with many of them. It's a great idea to get the education you need. Maybe you spend $5,000, $10,000, $15,000 or more. A lot of these schools have great programs offering a chock full of stuff. Well, if you spend $10,000 and start your trading business 3 months later, what do? The pre-business education is not deductible. Well, you try to squeeze it into startup costs, Section 195. That Section 195 and Section 248 for organizational costs are elections where you can capitalize your pre-business startup and organization expenses, and then each of those code sections allows $5,000 as an expense allowance the first year. And then startup costs, the rest of it is over 15 years straight line. So if you start your entity 2 months from now, you could go back 6 months. That's how far we go back for Section 195. We go 6 months back for a reasonable amount, reasonable period. So again, stay clear of the promoter's false promises saying you can deduct all your education, use C-corps and LLCs in a multi-entity scheme. You can't. You'll spend thousands of dollars with them, and it will fail, and you'll have IRS troubles in most cases. Now, we've been talking about these business expenses and trader tax status and the entities. Well, these are the business expenses that we're talking about, and they're unlimited when you have business treatment. So again, this applies to a business trader with trader tax status, and it applies to an investment manager with money management tax status. Now, you can also get trader tax status in your hedge fund to pass on those benefits to your investors. You can't do that with managed accounts, but you can in your hedge fund. A lot of what we specialize in and talk about, you can bring into your hedge fund for the benefit of your investors. Now, business deductions are Section 162. Trader business, they're far better than restricted investment expenses 212. Business treatment gives the full ordinary loss deductions, and they're part of net operating loss carrybacks in years you don't have enough income. You carry it back 2 years for a huge refund. One of the big ones is home office. It's a huge deduction in value. Prop traders get it too. Money managers get it. If you have a business and you work at home and you have an exclusively used office, it's a big one to get. Section 179, 100% depreciation. Education expenses after business commencement. Startup expenses going back 6 months. Organization expenses, margin interest. Trading equipment, software, services, supplies, the works. Travel to trade shows, some meals and entertainment too. Now contrast that with investment expenses, which are much more limited. How are they limited? First, they exclude home office, they exclude pre-business education, they exclude startup. Investment interest expenses are restricted to investment income. The rest is carried over. What you're left with is limited to 2% of adjusted gross income. Make it that far, and it's not deductible for AMT. Many seminars, online classes, travel to seminars are not deductible as investment expenses. Now, if you have managed account advisory fees for investors, they are investment expenses. So when your investors pay you advisory fees and you're doing managed accounts, they're stuck with investment expense limitations. If you put them into a hedge fund instead, you could get a profit allocation rather than an incentive fee, so your investors are not stuck with investment expense limitations for the profit allocation. They just have a reduction of capital gains. So again, a lot of these concepts can be applied in the hedge fund world too. Here's the best overview for traders. Let's see how we're doing so far. Just take a quick break here. Yeah, we have more people joining us. That's great. If you missed the first part, go back and listen to the recording later. Let's see if we have another poll question here to keep you all on your toes. And just one second. And let me just go back up the screen here. Let's launch the next poll question. So far, are you interested in setting up an entity to trade your own funds? From what you've heard so far. So text in your questions, yes, no, not interested, no, already have an entity, or maybe be interested. Let's get your answers in. And I'm not trying to convince anyone or swing you one way or the other. I just want to get you the information, and you may want to read more about it on our website and discuss it with me at some point. So get the answers in. I see most of you are voted. That's great, by the way. We've got 72% voting. You're all on your toes. That's wonderful. You're all attentive here. So let me close this poll now and share the answers. Pretty interesting. 53% say yes, you're interested in an entity. 3% say no, not interested. That's a very low number. But that's understandable because you came to this webinar for this subject. 12% no, already have an entity. Again, we're going to show you how to use it better. 33% may be interested. Great. We're going to try to see what we can do about that. So let's go back to the screen now. So this is an overview, a quick overview, and then we're going to drill down. We're talking about one simple pass-through entity. It's all you need. You're going to pass the income and loss to your individual return, so you don't pay entity-level taxes. Now, all those stocks that you trade day in and day out, those are C-corps. They pay entity-level taxes. Hopefully they pay you a dividend, and that it's a qualifying dividend. And you shareholders pay taxes again on those dividends. And that's why people say corporate taxes are too high. There's double taxation. Well, they can't be pass-through entities. There are way too many shareholders. Now, when you trade in a master limited partnership or an ETF, that's a publicly traded partnership for futures, you get a K1. That's a pass-through entity. They're passing income through to you where you pay the taxes. They don't have double taxation. Well, this is what we're talking about for small business. And most small business in America has a pass-through entity. And that's why the Republicans are always saying, wait a second, Democrats, you can't just raise tax rates on the rich. Those are the job creators with small businesses. They keep saying S-corps. Most are LLCs filing as partnerships. So the individual rate is the business rate. because that's where they're paying their business taxes. And that's what you want to do. You don't want two levels of taxes. You want one. You can do it because it's a small business and there's not too many shareholders. It's a little trickier when you do it this way. You have to take the pie out of the oven, carve up the pieces of the pie, and then each owner of the pie eats their piece and pays their taxes. And you do this with a hedge fund too, by the way, a U.S. domestic hedge fund. It's only the offshore hedge fund that's more like a C-corp. So the entity, again, it unlocks the AGI deductions. You can't do that with a Schedule C, not at all. Now, married taxpayers should generally use general partnerships. They're already filing together on a joint individual account. They don't really need liability protection. There's no customers or investors. And it's just so easy to set up and close. And there's no state filing fees, no minimum taxes, no annual reports. It's the least expensive, simplest thing to do. Almost like trading a joint account now. Very little difference. Only you can do all these get all the benefits. Now, in some states where the LLC costs are pretty expensive, like in California or in Texas that has a margins tax on LLCs, that general partnership is the way to go. Same in New York State and City, where the New York State has an LLC publishing requirement. So there are some jurisdictions where flat out the general partnership is absolutely 100% the way to go. But there are other jurisdictions where, hey, it costs a couple $100 more for the LLC. Maybe just form the LLC. Maybe you'll morph into investment management down the road. So it depends on your state. Now, if you're single, you don't have someone to be your general partner. So then we say you should use an S-corp, and we prefer to get there going through a LLC, a single member LLC. You can get there through a C-corp too. So if you're in New York State where LLCs are expensive, you go with a C-corp. This advice has to be customized. A nice, neat thing is the entity doesn't file that dreaded Form 8949, the cost basis form, reporting form this year, with those crazy botched 1099s and nightmares that our clients are going through, unless they use TradeLog to knife through the problems. But still, as an IRS oversight, exams, this is something that's great to avoid, and you can do it with an entity. And this is where you can just be an investor. Avoid the 8949 and then qualify for trader tax status later in the year or maybe in money management. So you still may want the entity just to skip this headache. Now let's drill down now more on entities. Some of this we touched on already. These are my slides from Dallas. It's going to draw less attention, give you more flexibility. So you're filing a separate entity tax return. It's a better option for business traders rather than the Schedule C. It reduces the red flags. We went through this already. Schedule Cs have historically drawn more attention from the IRS. And again, the trading gains are never on the Schedule C, so it just draws attention. Again, the entity can unlock the late MTM elections that you can do now for the rest of the year. It's going to drive the earned income deductions. Now, if you're an investment manager, you're getting earned income management fees, you can do your retirement plan contributions. But when you're a trader, remember the glass is empty. You don't have any earned income unless you're one of the exceptions, like a member of a futures exchange trading futures. And we'll go over those exceptions later on. So you want to generate these AGI deductions. These are 100% deductions from gross income. They're not business deductions. They're AGI deductions, but it's the same thing. It's 100% deductible. You can do one of these great retirement plans like an individual 401k. We've covered these in other webinars. Put away $17,000 plus $5,500 more if you're over age 50, plus do the same for your spouse, plus have a 20% profit sharing plan. Between you and your spouse, you could put away over $100,000, saving all those income tax rates. and paying some self-employment tax, but far, far less. You're gonna put $2,000 to over $20,000 in your pocket with this strategy. You're going to deduct your health insurance premiums 100%. If you have the Schedule C and you're a full-time trader and you don't have any other earned income, you can't deduct any health insurance premiums. Zero. And health insurance premiums are only going up. You want these deductions. They're worth thousands of dollars to you. So again, the problem is that you don't have earned income from trading. That's a good thing. Hey, who wants to pay payroll taxes, self-employment taxes? So in order to do it, you're going to have to financially engineer some earned income by paying yourself a fee. In partnerships, we suggest an administration fee to the owner-manager. In S-corps, we prefer using payroll, although administration fees may be possible too. Administration fees have far less compliance than payroll. Payroll requires payroll tax returns, workman's compensation, unemployment insurance, which can be expensive in states like California or Texas. You can have a Paychex can just do this for you just for December, bang it out, very low cost, not a big deal on the payroll, but we probably can do the administration fee instead, and then you just have a simple 1099. And we just have to work on this in December, do some what-if calculations, see how much is it going to save me if I do this retirement plan contribution, if I deduct my health insurance. You'll know how much your health insurance is. We'll do the what-if tax calculations. You'll see if you have the cash flow handy to set aside in a retirement plan. And you and I together, or CPAs rather, will make the decision. I'm a CPA too, but I don't do the tax prep. Darren Neuschwander, my partner, heads that up. They will determine the right amount for you to pay yourself as a fee, and you'll make sure that that fee is paid before year end. If you've already taken distributions of profits, we can just recharacterize some of it as a fee. So stay with me here. I don't want to lose you in the details. You can always come back to us on this. And let's see how we're doing on the board here. You all look pretty attentive. I see on my dashboard. That's good. Get some questions up on the board too. I don't want to get you too drilled down on details, but I do want to cover the specifics. You did come here to learn it. We still have a great attendance here. Thank you. And I just want to see when Brent Gillette is going to join us. He'll probably come closer to 5. All right, so we're back here. So don't use a cookie cutter approach. You have to see what your situation, what kind of trading you're doing, if you're married or not, what your future plans are, if you're going to move or not, what strategies you're going for. All of this is taken into consideration for picking your entity strategy. So again, they're required for investment managers, but recommended for traders. Traders don't need the liability protection. Investment managers do. One size doesn't fit all. We've covered that. Now learn the difference between an in-state and out-of-state entity. A lot of traders see webinars on asset protection, usually from attorneys, estate attorneys, and they talk about achieving asset protection in tax-free states like Nevada, Wyoming, sometimes Delaware. And sometimes they even talk about tax avoidance, like hiding income, and you always run away from that because you'll get busted on that. Now, these strategies appeal to tax crooks, and they appeal to some people for estate planning, but they don't work for traders, and they're very dangerous in general. And they should not, there should not be the snake oil circuit, salesman circuit. Keep in mind, if you live and work in your home state and you're going to trade in your home state from a home office, any entity you set up, if you want asset protection, you're going to need to register it in your home state. So if you have a Nevada entity, you're going to need to register it in New York. Otherwise, there is zero asset protection. New York State won't acknowledge the LLC. Now, we don't want C-corps for trading because we'll go through that in a minute. Losses are trapped. You don't get 60-40, double taxation. It's a huge error for trading. Well, if you're going to use a pass-through entity, which we said we want, you're going to pass the income to your home state anyway. So it makes zero sense to set up your your trading business, it makes zero sense to set up your trading business in Nevada or Wyoming. Now, if you're going to, it's different for funds and management companies. Those you definitely do want to set up in Delaware. And if you get sued by an investor, the Delaware is better for charging orders. And then you can register your management company in your home state. So if you're talking about investment management, I like Delaware, not Nevada and Wyoming. I like Delaware for your management company. And then if you're doing business in New York, register it in New York. We'll go over that more. But if you're trading your own funds, skip all those out of state. Just form it in your home state. And it might just be a general partnership. In most cases, it is, because most traders happen to be married. And that's not formed in any state. It's just an IRS vehicle. So don't get all confused by these snake oil salesmen. Maybe some of that can be applied to your investments and other assets, but not to your trading business. And I think a lot of it's snake oil. I do think estate planning is important because states still have low amounts, like $1 million in New York for the estate tax. And the Bush-era tax cuts may expire. They're scheduled to expire. And the estate tax can come roaring back, a huge problem. That's why it's so just ludicrous that they won't decide it, leaving everyone hanging in the balance on all this. That's just unfair. So pass-through entities are best. We covered that. That includes the general partnership, the multi-member LLC that files a partnership return. They're no different. The general partnership and the husband-wife LLC versus the husband-wife general partnership, it's the same partnership tax return 1065. The LLC has liability protection. The general partnership does not, but a trading business doesn't have any investors. They don't really need liability protection. If you're worried about someone falling in your house and suing you, that's coming through the back door. They can still get at your LLC assets. If you want to protect the backdoor risk, have proper insurance, number one, and two, consider a trust, and you can convey the interests of a general partnership to a trust, giving you both backdoor and front door protection, all the protection you need. Now, if the LLC is very low cost in your state and you may morph into money management or you're in a litigious situation, like maybe you're a physician, sure, we'll go with a multi-member LLC. That's fine too. And if you're a single member, then we have the S-corp election option. The S-corp return is not quite as flexible as the partnership return. Requires a little bit more work and before year end. So that's why I prefer the partnership approach. So with the pass-through entity, it's simple, easy to form, inexpensive. The C-corp is out. It's got a lot of pitfalls. You don't pass through losses. A lot of traders get started and they lose money. We built our company, GreenTraderTax, since 1997 on that Section 475 mark-to-market accounting because we know traders sometimes lose money, oftentimes lose money, and more than half of traders lose money. And you need to deduct your losses. You want to get immediate tax relief. You don't want losses piling up unutilized in a C corporation. Big mistake. You want a pass-through entity to pass them through. If you do have profits in your C corp, you don't want double taxation. Corporate rates are high. They go up to 34, 35%. And you don't get lower 60-40 tax rates on 1256 contracts, futures, E-minis, electing Forex traders, ETF options. You don't get that in a C corp. Maybe you want to have a special fringe benefit plan like a medical reimbursement plan. If you have huge medical, not covered by insurance, but these are tricky to set up, we can always add a C-corp to the mix if needed. That's 1 out of 1,000 times. Our competitors want it every time. They just want to collect fees on all this stuff. Avoid those schemes. If you're a single trader in New York City, you might need a second entity like a C-corp, only to be your partner in a general partnership. If you're single and you can't have a general partnership, but you're in a jurisdiction that absolutely reams you for not having a partnership, okay, we set up a general partnership and we set up a C-corp to own 1% of it. And we run it flat. Big deal. That's cheaper than having a spouse. Although that's just a bad joke for some. Funny for others, and I take it back. Let's see how we're doing here on the board. We still have a lot of you here with us. We're doing good. And I see that Brent Gillette has logged in too. That's great, Brent. I'm going to be turning over to you pretty soon, so I'm glad you're here. Stand by. It is 5 o'clock, Brent. We're almost ready for you. So stand by, Brent. So which entities to choose? The general partnership is great for your spouse. It's just the cheapest. We went through this. The LLC is okay too. If you're a single, you want the single member LLC with the S-corp status, because otherwise you disregard it. A single member LLC is a tax nothing. And then you're stuck with that Schedule C again. So one person sets up an LLC and owns it. They're disregarded, but they can elect to be taxed as an S-corp or a C-corp. So an LLC can file as a partnership, but you need a second partner. And I don't want you to just pick anyone. This is very tricky stuff you're talking about. So if you're married, you're covered. You're either multi-member LLC or a multi-member general partnership. If you're single, you go with the single-member LLC with the S-corp election. Now, start off with a consultation with me. Right now it's $150, but check out this promotion. You can get 20% off. Then you upgrade to the entity formation afterwards, and our firm forms this trading entity for you because it's your own money. And we have some new packages we're coming out with where we have the entity formation, the accounting you need, and the tax preparation, all in a great package. Now, if you're talking about managing other people's money, then we don't form the entity for you. That's when you get into working with Brent Gillette. Now, we touched on the retirement plans a little bit. Come back to our website to read about them. And I want to get into Brent Gillette now. Now, again, for traders, they don't have earned income. So it's not self-employment tax, and that's an expensive tax. Most online traders are exempt from it. On the base amount of $110,000 for 2012, the whole 15.3% applies, although there's a 2% payroll tax cut, which hopefully will be extended through past year end too. After that, the Medicare tax is unlimited. It's 2.9%, and that raises to 3.85% in 2013 with the health care tax changes. So trading gains are exempt from this. You pay yourself a small fee, you pay this tax, but the income tax savings is much greater. So if you're paying a 13.3% after the payroll tax cut on this first part of this, that's what you're paying, and half is deductible. The income tax savings are at 25, 30, 40%. If it's at 40%, you're putting 25% of it in your pocket. That's where I come up with thousands of savings. Check the math on our website. So if you're a futures trader and a member of a futures exchange, you have earned income under Section 1402I. I'm not talking about an electronic corporate member, a reduced membership. That doesn't trigger it. If you're a prop trader getting a Form 1099 miscellaneous, an independent contractor, that's earned income. If you're getting a K-1, it's not. If you're an investment manager getting management fees or incentive fees, that's earned income. Now let's get into the good stuff with Brent Gillette and do a few more poll questions, so stay tuned here. Now, what I'm going to talk about next is of interest to you. Don't leave, because whether you have investment management or you have a side business doing consulting or anything else, you can use these strategies to reduce some of your taxes too. So stay tuned here. Let's do a few more poll questions to keep everybody really interested here, and we're going to go a little late as well. Let's see. Are you trading other people's money now? Are you trading other people's money now? Or have you really been asked to trade other people's money now? So what I'm looking at is, yes, you're doing it maybe informally without really dotting all the I's, crossing all the T's. That's where Brent Gillette comes in. Or yes, you're using a proper setup, licenses, registrations, agreements. You've done it all right. No, I'm not interested in investment management. No, but I'm interested in it. All right, so half of you are not interested, but the rest are. So before we get into this, I just want to show the rest of you something quickly. What I want you to do now, we're going to talk about some of the money management, but if you are not really that interested in investment management, don't forget to contact us on our website and check out that special offer. Now let's get into this really good investment management stuff. This is important. And before we do, let's jump back up and introduce Brent Gillette. Actually, I introduced Brent Gillette already above. Brent is that senior managing partner of Investment Law Group. He handles all the investment management. Brent, let's see how your sound is. Go ahead. Okay, back with the recording, and Brent Gillette has joined us, which we're very happy about. Now remember, managing other people's money can be a risky activity, so you absolutely need to have an entity for liability protection. And attorneys and clients prefer LLCs these days in most states, so do large investors in terms of governance. I heard that from a fund-to-fund manager one time recently. With the corp, you need annual meetings. With the LLC, you don't. Brent, tell us why you think all investment managers need the LLC and why you maybe prefer it over the corp.
Well, if you're managing money as a sole proprietor, then if there are any claims against you as a manager by your clients, then you'd have personal liability to the extent that the manager has any assets. And so I think it's a very good and obvious reason to form an entity. It's very it's not an expensive undertaking to set up an LLC or an S-corp, and so simply for liability protection, I think that it makes a lot of sense.
Now, Brent, recently I was working with a client, happened to be an attorney, a litigation attorney from New York State, and he wanted to set up a trading entity for just himself. And we, at the end of the day, we decided on a Delaware LLC that he would register to do business in New York. And he was insistent on the Delaware LLC. He told me that, Bob, I'm a litigation attorney. I've sued so many New York LLCs, and I feel that with the charging order rules and how it works, I don't think the New York LLC is worth the paper it's printed on. I just prefer the Delaware LLC. The courts have a much better understanding of investment management too, and then you just register in your home state. Do you agree with that, Brent?
I do. I mean, it depends on you're going to. The downside is you're paying extra fees, so you're paying Delaware probably close to $500 a year for the renewals of the entity plus the registered agent fees, maybe closer to $400. Not a lot of an. It's a relatively small expense to gain access to courts that might provide the manager with more favorable results. So it really depends on the state and also where the harm is actually done. If the alleged harm occurs in New York, for instance, and any litigation that would occur in a New York court, but they would presumably have to apply Delaware law if that is indeed sort of the way the contract is written. So in the client agreement, there is an understanding that Delaware law would apply, even in the case of a case that's tried in New York. Then Delaware law may indeed be more favorable. And in my experience, the courts in Delaware are very sophisticated. Not to say that New York courts are not, but there are such a large amount of corporate-related litigation that you're less likely to have an arbitrary and capricious result just because of the sophistication of the courts and all the precedents. So I think it's not a bad idea, and it's also a common practice for our clients to set up their management companies, even when they use a three-entity structure, which we can get into in a moment. They would establish the fund, the general partner entity, and the management company all in Delaware, and register the management company in New York.
Right, and a lot of our clients, Brent, are all around the country, and some are in states where they're very unfriendly towards investment management. And if you're forming the hedge fund itself, a limited partnership, if they have a hedge fund, sometimes it's just single managed accounts as an advisor. If you have a hedge fund in Delaware, according to Delaware law, why not have the management company in Delaware according to Delaware law too? And a couple of tax points, and then we're going to move forward on this, Brent, and get into the three-entity structure as well. So the LLC can be taxed as a disregarded entity, a tax nothing. I don't think it's such a good idea. A lot of attorneys don't like it because they think you break alter egos easier because it looks like it's part of you personally. So we prefer electing partnership or S-corp status or C-corp status for that LLC. And let's go to the next page, Brent. With your LLC, you're going to choose between partnership or S-corp tax filing status. I'll knock out a few of the tax points and then back to you on the law points, Brent. If you have, now we're talking about the management company. So again, when you're in investment management and you're going to manage money for others, you want to protect yourself, and you're a management company. And Brent, you'll explain that it's the management company that registers as a CTA or as a RIA. And if it's an RIA in the home state you're operating. The hedge fund is maybe a second entity that you're forming just to pool investors. But the management company is where you're getting your income. And that's where you want to decide on your taxes in a tax-advantaged manner. So just this point about S-corp versus LLC. If you have other owners in your management company, you're a big operation. You have a few other people helping you out, junior traders. And you want to have special treatment for yourself, preferential treatment. You want to get a much bigger salary. You want to get a carried interest. You want to get treated differently than the other owners. Well, an S-corp can't have a second-class stock, so you can't have an S-corp. And that's a bit of a problem because it's the S-corp that can reduce those self-employment taxes. Now, you can also reduce self-employment taxes by having a big carried interest, which doesn't trigger earned income. So speak to Brent or me about what your situation is. If you are the only owner of the management company or it's a couple of people and you don't need preferential treatment, you're probably going to want to consider the S-corp approach to reduce earned income unless you're in a state that taxes S-corps and or you have very large carried interest. Now, a lot of these factors, whether you have carried interest or not, it's all legal. You got to work with Brent Gillette on it. He's got to see if you have qualifying clients, if your state allows it. So that's why you got to work with Brent on the one hand and GreenTraderTax on the other. It's all dovetailed. So as I said, New York City doesn't allow the S-corp status. Plus, some states have franchise taxes as S-corp. So, Brent, in New York City, as an example, clients may want to use two entities because they may want one entity for carried interest and one entity for management fees because they don't want the carried interest to pay New York City UBT tax, unincorporated business tax. You just mentioned before you wanted to talk about that a little bit.
Sure. Yeah, that's so that historically has been and still is the preferred structure. So most hedge funds are structured as partnerships, and so the general partner would receive the incentive allocation. And in many cases, outside of New York, the general partner would also receive the management fee. However, to avoid the imposition of the unincorporated business tax on the carried interest payment or performance fee element, we also call that the carried interest. Many hedge funds will actually set up, using a three-entity structure, as I was just discussing. So there'd be an investment management entity, a general partner affiliate, and then the fund itself. And this bifurcated structure not only helps to clearly establish the functions for each entity, but it also distinguishes the source of income from the entities. So in this structure, this three-entity structure, the investment manager would be structured either as an unincorporated entity, an LLC, or as a corporation that performs services for the hedge fund in exchange for a management fee. And only the management fee would be subject to the UBT tax. And the performance fee component would not. However, although there's no formal guidance yet provided by the department, New York City tax officials have informally told a lot of hedge funds and practitioners that they are going to start looking a lot more closely at the expense attribution for partnerships that are generating a lot of carried interest. And so what they're trying to potentially do is require the hedge funds to allocate a lot of the expenses away from the management company and apply them to the general partner entity. And by doing this, they're increasing the revenue base that's taxable with respect to the management company, because they can't, all the expenses can't be applied to the management fee. So there's going to be more fee that would be potentially taxable as UBT. So, this is all going on right now, and there's some, I think there are a couple of large audit firms, Pricewaterhouse being one, that recently published, they made the statement that they've been informed of the position by the department, and so everyone is sort of concerned about this. Unfortunately, there's not a lot of clarity as to sort of what's happening. Most of my clients are smaller hedge funds, and for that reason, I don't think they're really going to be targets. We're talking about fairly minimal amounts of revenue when you look at their modest expenses. So I think it's really the larger funds that the department's going to really go after if they do. So right now, the structure is still alive and well. Carried interest is alive and well, and certainly very tax advantageous to structure a hedge fund organization to avoid UBT and take advantage of the ability to get long-term capital gains treatment.
So what it's all about is slicing and dicing the underlying income and the fees and carried interest so that it has the best tax treatment possible. I'm not sure all these slides were viewed. I had a poll open, Brent. I'm sorry about that. So people may have missed this first slide here, which we discussed, and then the second slide, which we just discussed. So go back and watch the recording later, and we may make some slides available too. On that S-corp strategy, if your management company gets a lot of fees, or you're doing managed accounts and you can't get carried interest, you can only get carried interest if you have a hedge fund. That's one of the main reasons to have a hedge fund. If you're getting a really high incentive fee and management fee into your management company, that S-corp strategy can really reduce that SC tax quite a bit. And you're talking about reducing next year 3.8%, this year 2.9% times 75% of that income. That could add up to a nice amount. Now we're back on the slides here. We're going to talk about hedge funds here, Brent.
Yeah, and on that note, Bob, I'm actually we're looking at kind of restructuring our firm as well to take advantage of that, because of so it really can be very significant.
Right,
and obviously you have to be careful about how much one takes in terms of salary, because that can be challenged. It has to be reasonable, as I'm sure you were noting earlier.
Right, 25% we want to see. Now this loophole, the Democrats tried to close it, and I've written about it in the blog. It's in Green's 2012 Trader Tax Guide. There's a whole chapter on investment management where I go over this whole strategy. This is the S-corp SE tax reduction loophole. John Edwards famously used it before he was a senator, when he ran like $75 million of his law firm revenues through an S-corp. So the IRS, everybody knows about it. Computer consultants use it. Any kind of business, if you have a business generating earned income, consider this strategy and check with us about it. And we can elect the S-corp status after the fact. Even if you have a late S-corp return with a few dollars of penalties, it's worth it. Now let's talk about the hedge funds, Brent. The management company.
One quick question: when can you make that S-corp? If you're, say, someone's operating an LLC now, do they have to do it?
Well, you can still fix it for 2011, Brent. If you file an S-corp return by September 15th, 2012, you can file your firm's an S-corp return for 2011, but there'll be a late, if you didn't file an S-corp extension on March 15th, there'll be a penalty of like $150 a month per owner per month. But even if that's, a couple $100, or it could add up already, the savings can be still pretty large. So yes. That relief is available on federal and in most states, because normally you have to make the S-corp election within 75 days of inception or the start of any given year. But there is a special Rev Proc with the Form 2553 to file, and check with us and we'll get you that, Brent, or anyone else who's interested. So now back on the hedge funds, U.S. investors generally invest in U.S. or domestic hedge funds. They are generally formed as limited partnerships in Delaware. That's what Brent Gillette does day in and day out. Sometimes an LLC can work too. And Brent, I want you to explain to us the difference between using an LP and an LLC. But let me just quickly say, with an LP, you need a general partner, and that is your management company, LLC or Corp. Now, LLCs don't have a general partner, and everybody has the liability protection, but in a limited partnership, the general partner doesn't have liability protection necessarily, but he does have it because he's an LLC in its own right. Now, I know customarily most hedge funds are LPs, and that's what most law looks at and most lawyers are comfortable with. What do you say about all that, Brent? The LP versus the LLC.
The limited partnership has been the most traditional structure for hedge funds and just any kind of investment partnership, private equity funds, real estate funds. We have seen a trend towards more LLCs being utilized for investment partnerships, and in my opinion, they're very, very similar to one another from both a legal and tax standpoint. I would say the primary benefit to an LLC structure is that an LLC provides limited liability to the manager, which would serve as a managing member, whereas the LP structure, in the LP structure, the general partner has unlimited liability. So if one is going to actually sponsor multiple investment funds, it may be a good idea to use the LLC structure, because if there's a problem with one fund and there's a lawsuit against the GP entity, it would sort of create problems if the manager were to just bankrupt the entity, and yet it still has active businesses with respect to the other funds. So generally speaking, I think investors are more familiar with limited partnerships. Also, certain classes of investors, like Canadian investors, are going to want to invest in a limited partnership as opposed to an LLC because of specific tax consequences. So that can be negative to Canadian investors if they invest in an LLC. but I'd say the vast majority of the funds that we're forming are still limited partnerships.
You know, all along, Brent, I thought the LLC was a good way to morph into. You just said something really smart that caught my attention. Let's say your management company has $1 million in it. I mean, you have a lot of assets. You trade some of the money. Maybe you shouldn't. You have a lot of assets, and you get sued from a hedge fund. Well, yeah, you have liability protection to go past your management company to yourself, but the assets in your management company are at risk. Why not have that extra level of protection with an LLC where your management role is protected inside of the fund rather than just letting it come into your management company?
I agree, and also we always advise our clients to thinly capitalize their management companies,
right,
and not invest the management company assets in the fund in any large way. You know, to the extent that the manager wants to make a large investment in the fund, which many do because they use that as a marketing. From a marketing standpoint, it's going to be more persuasive if your manager is investing alongside you as an investor. So we always advise the managers to invest as limited partners, just like any other limited partner would invest, and not invest through the general partner or management company.
Right. I mean, if they ever change the carried interest rules, they may want to invest more as a manager, but that hasn't happened. Carried interest still has survived. Now, Brent, I've heard people say, well, some foreign investors, like you mentioned with Canada, prefer the LP, but you're usually putting your foreign investors into an offshore fund. So if you have just U.S. investors in your domestic fund, I think the LLC is a direction worth pursuing. Now, I have a feeling that a lot of attorneys have a lot of documents prepared as limited partnerships, and they know the law, they're comfortable with it, they're reticent to just change so much without, having to redo things and retest it. Is that part of it?
Yeah, I definitely think that's part of it, just kind of laziness. We're happy to set up funds either as LPs or LLCs. We've modified our templates that work equally well with either entity. And we also set up a lot of incubator funds now as LLCs. In certain cases, it might not make sense for the manager to set up a management company. It's an additional cost, especially in California, where you have such large, there's a minimum $800 franchise tax. And so a lot of our California-based clients choose not to form a management company right out of the gate, but instead will just form an incubator fund as an LLC and capitalize it with their own assets. So it sort of depends, and that may not be as tax beneficial. I mean, when you have the management company, it may make certain write-offs easier to take, and that's more in your territory. But but for the tax benefits, it generally works just as well to have a single entity in certain cases.
Yeah, with the incubator, they run the trader tax status expenses right through the incubator fund, which doesn't necessarily have to register in California. What's nice about a management company is that you land in your home state and you keep your hedge fund virtual in Delaware. But if you go with the LLC and no management company at all, the question is why isn't that doing business in California? So some of these things are nuanced, and that's where people get value working with both of us, Brent. Because normally we don't register the Delaware Limited Partnership or LLC in your home state, whereas we do register your management company. I think in the case of an LLC, you could always maybe have a Schedule C, a sole proprietor management company of sorts or administrator of sorts that does business in California. And that's fine because you don't need liability protection. There's no investors yet in the incubator unless it's a friends and family incubator. And Brent, I know you've given separate webinars on the incubator strategies, and we should do one of those again soon. So again, on this last point, the Delaware LP or LLC files a partnership tax return, and investors receive Form K-1s for their share of all underlying income, expense, gain, or loss. State returns are generally not filed for the hedge fund because you're formed in Delaware, but there is no Delaware tax filing. You're not really doing business in Delaware. And a few clients have been confused by that. Now, Brent, why don't you explain one of your flow charts here about the domestic fund?
Sure. So most of the funds, as I mentioned, are formed as investment partnerships in Delaware, and the investors would, in the case of a limited partner, the investors would invest as limited partners, and they would not have any liability other than their investment into the fund. And then the portfolio manager is typically going to be structured, in many cases, as there will be a single entity that would often be an LLC that would serve as the general partner to the partnership. And in cases where we have a New York-based firm, we might have a third entity, which is not shown here. So here we show really just a traditional two-entity structure, which is fine for most states, pretty much all of them except Texas and New York. And so that keeps costs down a bit. So you have the portfolio manager who is a member of the general partner entity, which manages the partnership. So this is just a very traditional, simple two-entity setup for a fund.
Yeah, the third. This would be the third entity in a sense for.
Right. Yeah, exactly. And what we would do is instead of the portfolio manager being a member, he would actually that would be a third entity, exactly.
Now, Brent, why would someone, if someone, let's say, they want to manage other people's money, so they're going to need a management company for liability protection, and they can have separately managed accounts. And last week you mentioned about the problems with PAM accounts. Today we pointed out some really nifty tax benefits from having a hedge fund like the carried interest. But what are the other reasons why someone would want a hedge fund, Brent?
Well, other than the carried interest is a big one, but there are a number of other benefits to operating a pooled investment vehicle, such as a hedge fund, rather than having managed accounts. A lot of my clients used to work at the larger wirehouses where they were brokers or financial advisors, and they just became disenchanted with the lifestyle of really all the hand-holding that goes along with acting as a financial advisor. And some people are cut out for it, others are not, and others, so one of the benefits of a hedge fund structure, one of the main benefits is that the fund itself is really the only client of the manager. He no longer has dozens of retail clients who he has to answer to every day. So typically the investor in a hedge fund would receive a statement on a monthly basis that will let the investor know the value of their investment in the fund. Each investor has a capital account in the fund that's tracked separately from all the other investors' capital accounts. And really that's the primary information, other than maybe a quarterly newsletter that the manager would send out. That's the primary information that the investor will receive about the value of his or her investment. In a managed account structure where the investor or customer opens an account at whatever brokerage firm he or she chooses, or his or her financial advisor might select, the investor then, customer, would have 100% transparency on a day-to-day basis as to how the account is being managed. And so one downside is that the manager loses the ability to keep his proprietary trading strategies proprietary. The investor could even shadow the account and manage money on the side, taking larger positions with larger amounts of capital, in effect not paying the manager for the services they're providing, because they can just in essence reconstruct the exact same portfolio at a different brokerage firm. So that's one risk. The customers typically are going to have, because of the transparency, there's going to be more maintenance, more questions that come up on a day-to-day basis, just generally a lot more customer service obligations for the manager to deal with. And so in a fund structure, where everything is kept, there's not the kind of transparency that a managed account has, there's probably going to be a lot less in the way of questions, as long as the performance is good. Those are a couple of other reasons other than the tax. And lastly, in certain states, you can still avoid registering with any authority, the state or the SEC, if you operate a hedge fund. But it's much harder to do if you have managed accounts. In most states, if you have more than 5 managed accounts, you actually have to register as an investment advisor in that state. And also, if you have more than 5 accounts in any other state, you'd have to register in that other state as well. But by having a hedge fund, it's possible in certain states to actually avoid registration until you have $150 million under management. So from a regulatory standpoint, a manager can avoid, regulatory entanglement to a certain degree, depending on the state where he or she resides. Now, many states make hedge fund managers register regardless, but a lot of the states on the East Coast will permit managers to remain unregistered until they have $150 million, at which point they'd have to become SEC registered.
Well, that's good, Brent. I have your slide up there. I've been following you with the arrows as you've been speaking. You can see the slide too, right?
Yes.
On the screen, okay.
Yes. And yeah, I was might not have been keeping up with the arrows. I think the only other point maybe that I didn't mention that's on the slide would be the if a manager were to launch a mutual fund, the Investment Company Act significantly restricts the strategies, shorting, leverage. So through a hedge fund structure, managers can often have, use a lot more strategies than to generate profits than they might otherwise be able to in the context of a mutual fund.
Well, that's a lot of benefits versus all that hand-holding with the managed accounts. Now, Brent, give us, I got the slide up here about the overview of the incubator funds. This is your slide again. Why don't you walk us through this now a little bit?
So an incubator fund structure is really the same as a hedge fund structure. It entails setting up, generally speaking, the same entities, a limited partnership in Delaware and an LLC in Delaware that would register as a foreign company in the state where the manager resides, or we could just set it up directly in the state. And
or you said before it could just be an LLC with no management company.
Right, or it could just be an LLC with no management company. So there are some options, and these vehicles are flow-through vehicles. So from a tax standpoint, for the most part, the manager who's seated in an incubator fund will be taxed in the same manner that they would as if they had just a personal account. So there's no real tax disadvantage. In fact, by setting up an entity, a lot of the benefits of trader tax treatment that Bob, you spoke about earlier would be afforded to the manager. Generally speaking, an incubator fund is really only appropriate for a manager to seed with his or her own assets. We don't provide our clients who establish incubator funds with the same kind of documentation from a disclosure standpoint that they would receive if they launched a full-fledged fund. So full-blown fund offering documents would include a lot of risk disclosures and different types of risk factors that are relevant to the investment strategy, along with tax and ERISA disclosures. And so, because an incubator fund is so cost-effective, one of the things that we don't provide is the 100 pages or so of legal documentation that are typically provided to full-fledged funds. And it's really not necessary because, generally speaking, only it's just the manager seeding the fund with his or her own assets. Now, there are situations where we might feel comfortable with an immediate family member, a brother, sister, parent, investing alongside the manager because we think that the risk of a lawsuit is probably pretty low in that circumstance. But we really don't like to see friends or distant family members co-investing with the manager in the most basic incubator fund structure, mainly because there's not the appropriate disclosure. And not only can the manager have liability, but our firm potentially has liability, because when the manager is raising money for an incubator fund, the manager is actually selling securities. It's not always clear to my clients initially that interest in an incubator fund or a full-fledged fund are securities. So when you're raising money for your fund, you're selling securities, and we always have to be very careful whenever we're conducting securities offerings, and these offerings have to be made pursuant to typically the exemptions under Reg D. Now, if the manager really wants to manage money for outside investors, then the investment club might be a good structure. And in that structure, we will basically provide the manager with a full-blown set of offering documents. We essentially provide 95% of the same work product that we provide if we launched a full-fledged fund, but we removed the language dealing with fees. And so we discount, the project by about half of what we would normally charge for a full-blown fund, even though we're basically doing the same work, because we want to give the managers a break, and the idea is hopefully they're going to transition to a full-blown fund at some point, and then when we do that, we'll be paid at that point. So
now, Brent, let me just jump in here for a second. We've had clients over the years. A lot of people get involved with investment clubs, and they go to a broker. They're very informal. The ladies, my mom was in an investment club, and there's an account that says investment club with the broker. And, your family member might have like 1/7 of the club. And then, they try to get a tax ID number, but sometimes they don't. It might just go to the main person. They try to divvy it up. That's very informal and not appropriate, and that's not what you're talking about. You're talking about a friends and family incubator fund, a full-fledged hedge fund that's somewhere in between your own money incubator and a full-fledged hedge fund.
Exactly. That's exactly right. And so that's that's become an increasingly popular option because there are a lot of clients who do have prospective investors who are ready to write checks, but maybe they're not sure that the investor is going to invest enough assets to really make the whole business viable. So they want to sort of take baby steps, and the investment club structure is really the next step.
If the old ladies are sitting around playing cards, Brent, and they do this with a broker, no one of them is really the entrepreneur. But if you're an entrepreneur manager raising money from your friends and family, if you don't dot all your I's and cross your T's and do it right, it's at great risk. And Brent, when people don't do this investment management correctly, aren't they subject to rescission, and what does that mean?
Well, yeah, there's certainly a rescission right is the right that a state affords an investor who invests through a securities offering, whether it's in a hedge fund or any other type of business, and there was some law that was violated, that the securities weren't registered or weren't properly exempt, an unlicensed broker was involved, and the states basically enable the investors to receive a rebate of their entire investment along with a certain statutory interest rate, and that basically gives the investor a permanent put on their investment. So it's very important that all of the filings are done correctly at the outset, mainly the notice filings with the states where the manager is raising money. So we've certainly had situations where we've been able to clean up the filings for our clients where filings weren't made on time or weren't made at all, and we've been fortunate that we've been able to sort of get through the situations without a problem. But where there could be a problem is if the manager loses a lot of money for a particular investor, the investor complains, hires an attorney. At that point, if the manager hasn't set up the business correctly, hasn't made the right filings, there could be a lot of liability, even potentially personal liability.
Now, Brent, we're going to wrap up soon. And for fund administration, I know that you have an affiliate that can help with that. We have that at Green Trader Funds, too. People can pick the right choice. We are also very interested to do the tax and audit work here at GreenTraderTax, our CPA firm, Green NFH LLC. So we can do the tax and audit, and Brent's affiliate can do the administration. So we will help you figure out a great strategy for you that's very cost beneficial, and make other recommendations as well. We just want you to get the best service providers. Now, Brent, some people have offshore clients too. They have the world is their oyster now. There are a lot of great U.S. managers, great markets here, and a lot of people around the world in the BRIC countries. Otherwise, they have a lot of money to invest, and they may be an entrepreneur here in America, in India, or here in China, and they want a foreign offshore fund for their offshore investors. So we're just going to touch on this today, so maybe just give us a little on this as we then wrap up, because this is pretty much the last slide, I think.
Okay. Yeah, we found that certainly the world is getting smaller, and There are lots of non-U.S. investors who are interested in placing money with U.S.-based managers, and we often set up offshore funds to accommodate the investments from these non-U.S. investors because a lot of them wish to remain anonymous. There could be certain tax benefits in their home country to invest through a Cayman or BVI-based fund. We also set up offshore funds to accommodate tax-exempt investors who want to avoid what's known as unrelated business taxable income. A lot of our clients don't realize that if they're managing money for a tax-exempt investor, even someone with an IRA account, the portion of the profits that are derived from the use of leverage are actually subject to tax at the trust tax rates. And that can be significant. And one way to completely avoid those taxes is to set up an offshore fund and have the U.S. tax-exempt investors invest into the offshore fund rather than into the onshore fund. And
that's what Governor Romney did, right, Brent?
Yes, and then he was able to avoid UBTI. And there's nothing, a lot of times we hear, offshore funds and it can often create a general idea of something very sketchy and illegal. Just any money offshore is bad, and offshore funds are very common, very widely accepted by the IRS and other regulators. Some of the largest pension funds in the country, only invest through offshore vehicles because they want to avoid unrelated business taxable income. So there's nothing at all, sketchy about, an offshore fund.
Including all the government pension funds and the IRS workers too.
Exactly, exactly. So it's a very commonly used planning tool for tax-exempt investors, and one that, we often set up for our clients using either this master feeder structure that you're looking at now or a mini master structure. And this is a pretty complicated area, and that we probably don't have, beyond the scope of this call, to really get into all the details of this slide, but those are the two main reasons why we often set up offshore funds. I would like to say that there's a misconception that seems to be pretty common that U.S. taxpayers can avoid or mitigate taxes by setting up an offshore fund and sort of keeping the money offshore and letting it accumulate offshore and really not having to ever pay U.S. taxes maybe until they bring the money back onshore. And it's really not that easy. Offshore funds are deemed to be passive foreign investment companies, and there's a whole body of law that generally, there are a few exceptions that might make sense, but for the most part, it does not make sense for a U.S. taxpayer who's taxable to invest into an offshore fund. It's really better for them to invest onshore, and a lot of the tax benefits that the big hedge fund managers used to benefit from by setting up deferred comp plans aren't really, that loophole was closed a few years ago. So, offshore funds are really typically limited to use by tax exempts in the U.S. and non-U.S. investors.
Well, Brent, what I like about the master feeder and the mini master feeder is that someone's got an offshore feeder for the offshore investors and the tax exempts, and a domestic U.S. feeder fund for the U.S. taxable investors, and that can all be under one umbrella of a master fund and one management company, so you don't have to complicate your business too much over here, and you can separate these two feeder funds, and you can do it with a mini too. And I know we'll have some upcoming webinars from you, Brent, from the Investment Law Group, where you're going to actually walk us through all that. So why don't we show people how to contact us and maybe do a few more poll questions as we finish up here. We still have quite a bit of people with us. That's great. And let's get a couple of more poll questions out here to see what's left here. Let's see, out of all the things we discussed today about the entity, which advantages do you value in an entity? And I probably should have had the last choice here, investment management, but which of the values that do you see here? Get your vote in here. Are you looking for your business expense deductions? This is on your trading business entity or your retirement plan and health insurance. Do you want the flexible elections? Do you want the better tax reporting and no red flag, or the asset and liability protection? Remember, for an investment manager, you must have an entity. And not only do you need an entity, you got to have all the right agreements, licenses, registration, or exemptions from those licenses and registrations. And how do you know all that? You need to go to the NFA, you need to go to the SEC, your state. And when you read through the rules, they're very confusing. So the first stop is Brent Gillette. Let Brent sort out what you need to do and to suggest what you should do, give you a quote, and tell you what the up and downside of doing it, not doing it are. So let's share the results of this poll, and pretty interesting results. A lot of you, 83%, want the business deductions the most. That was, by the way, I believe a multiple choice question. Should have said that to you. 69%, well, it is, I could tell multiple choice because of it doesn't add up to 100. 69% want deductions for the AGI deductions, retirement and health insurance. Great, smart. 31% flexible elections. 69% better tax reporting. You people, I can tell, the ones who are left on this call, close to 100, you want all those values that we discussed. And I'm sure if you're an investment manager, you're going to want those values we discussed too. So I think we don't need to ask any other questions. Let's go back to our screen here. And that actually was the last slide. So call Brent Gillette. Brent, why don't you tell people how what you got coming up in coming weeks and how they should contact you? You're up here on the screen.
Sure. Yeah, Phil, we covered a lot in the last part of this presentation, and I'd be happy to answer any questions via an email or a call. So feel free to reach out to me. My contact information is there on the screen. And you can check out our firm's website, investmentlawgroup.com, if you want to learn a bit more about our firm. And we look forward to hosting some more presentations in the near future. We're hoping to have some presentations just focused on launching an investment management business, and we can really dive into a lot of the details as to what's involved from both a legal and operational standpoint in putting together a business to manage other people's money and how these businesses can scale. We can also discuss ways that hedge fund managers are using to market their businesses, and with the Jobs Act, there may be a general ease on a lot of the restrictions that historically have been in place, and so that probably will be another focus coming up in early July once we see the new rules that the SEC is going to come out with. So thank you very much, Bob. I always appreciate the opportunity, and hope everyone enjoyed this seminar today.
Thank you so much, Brent. I look forward to our future webinars. And just to wrap up on the trading business side, it's a great time to form it now, mid-year. Get back to us. We have our summer promotion that you can get started with. It starts July 1st, but you can get in on it now. It's actually the tail end of the Dallas Expo promotion that was just for the Dallas people who went to my paid session. I showed you that link before. Just call customer support with Mindy and she'll give it to you as well. The link was back up on the entities page. Let me get it. It's right here. So it's on Traders Entities promo. So just click that. And we hope to hear from you soon. So thank you all for coming. And please spread the word on this recording. And give Mindy a call anytime, 646-224-6923. You can also get in touch with Brent directly through our site or call Brent directly at 404-607-6940. Thank you, everyone, and we'll see you next week. Goodbye.